The split circuit monetary system. To be clear, we are talking about a circuit, two circuits actually, but circuit implies electronics. That's what we're talking about, electronic money, digital money, another way of putting it. What we are not talking about is cash. You just heard Carson said they hate cash because they don't know who's using it, they don't know what they're spending it on, and the totalitarians, they don't like that. So we're not talking about cash here today, we're talking about electronic money and how that control is going to be implemented. What is a split circuit? It's exactly like it sounds. It's two different circuits. One circuit I'll call the retail circuit. That's our circuit that we use to conduct our business. And the other circuit is what I'll call the wholesale circuit. That's really sort of a bookkeeping circuit, which I'll explain. But the retail circuit is private, and it's a private circuit because the issuers of money in the retail circuit are private entities. They're commercial banks. And in the wholesale circuit, the issuers of money are, at least in theory, public. That's the official story, is that public entities, for example, the Federal Reserve in the U.S., issue money because it's really that right to do that. The issuance of money is a sovereign right belonging to a nation, and in theory, the Federal Reserve is I laugh when I say it, is the agent of we the people, which is a ludicrous notion. But be that as it may, that is the official story. So the wholesale circuit, the issuer of money is public. It is the Federal Reserve. The team colors I'm going to choose here are red for the retail circuit, the private circuit, and we are going to go with a bleak blue for the wholesale circuit, which is, like I say, it's the bookkeeping circuit that really kind of is meant to sort of settle transactions in the private circuit. But I'll talk about that in a bit as we go. The private circuit. Let's take a look at that. In the private circuit, as I say, the issuer of money is commercial banks. Commercial banks issue money. They create it out of thin air when they lend. And then that money is circulated among bank money users, some of whom have taken out those loans, and then they pay that money back. The money is destroyed. New loans are created, and the loans get bigger and bigger and bigger, and that's just how the system works. So now let's look at the circuit of people who use that money. And let me answer a question or address something really quickly about commercial banks creating money when they lend. You might be saying, well, I have electronic money in my bank account or checking account, and I didn't take out any loan. So you'd be like me. I didn't borrow the money. So what are you talking about? That's true. I didn't borrow the money. You didn't borrow the money in your account, but that electronic money sitting there, if you could trace it back to its source, sort of in a Genesis begat sort of way, and you went up the chain, you would find that the source of that money, it originated in a loan. There's no question about that. So even though you didn't take out the loan yourself, you're using money that it originated in a loan, to be sure. No doubt about that. Okay. Who uses the retail bank money circuit? The commercial banks issue the money. Who uses it? Generally speaking, the users of retail money or bank money are non-bank entities. So businesses, we're talking about mom and pop businesses, industrial businesses, commercial businesses, really any business is not a commercial bank, including, financial businesses like, hedge funds and insurance companies. They are part of they transact business in retail bank money. That's one big class of users. The other major class of users are just people like you and me, just to finish off that circuit with a bit of cheese there. That's the retail bank money circuit, and that completes the circuit. There are 4,357 commercial banks issuing money. That's a bit much for the criminals, the totalitarians to control. They don't like that. That's too many to control. That number, by the way, comes from the FDIC's quarterly statistics at a glance report. There's over 4,000 commercial banks in the U.S. all chugging away, issuing money. And that completes the private circuit. Now let's turn to the public circuit. As I said, the issuer of money in the public circuit is the Federal Reserve. It issues money when it does anything, when when it wants to buy an asset, it just, writes basically a check against nothing and begins buying assets. Who is in, and that's what it's done since 2008. The Federal Reserve it creates money out of thin air, just like commercial banks do. Who is using money in this circuit? Broadly speaking, there are three classes of users. There are central banks like the European Central Bank and the Bank of Japan, and so on, Bank of England. That's one class of users. The other major class of users, the second, is the U.S. government, including, most importantly, the U.S. Treasury. And finally, far and away, the biggest user of money in the wholesale monetary circuit is commercial banks. So they appear in both circuits, but here they appear in blue and with a square around them. The square representing the fact that they are using money in this circuit. They are transacting in blue money. They are not issuing blue money. Blue money is issued by the Fed. There are not 4,000 issuers of money in this circuit. There are only 12, the 12 being the regional Federal Reserve banks. So the Federal Reserve Bank of New York, the Bank of San Francisco, Chicago, Dallas, so on. There's 12 of them, but really there's one. It's the New York Fed. The New York Fed is the only one that has a trading desk. It's a permanent member of the Open Market Committee. The other 11 are just appendages. There's really one, but officially there are 12. And really, it's considered the Fed, like I say, as a public entity. But the point here being it's a much smaller group of issuers, even if you were to count all 12. So that really completes the public circuit. And we'll see what that money is doing since it doesn't get in the retail circuit and we can't spend it. Why do we have that circuit? I'll talk about that in a little bit. But that's it. Let's talk about, and both circuit, by the way, are in dollars. They're both, the money circulating is in dollars. It's denominated the same. But there's a bit different nomenclature associated with each type of money. In the private circuit, it's sometimes called bank money because, commercial banks issue that money. And in the public circuit, it is called reserves. It's issued by the Federal Reserve. It's called different things in different jurisdictions. But in any case, both of those circuits, we have deposits. In the retail circuit, you and I have deposits sitting somewhere at the 400,357 banks. And there's more deposits than that because there's some banks that aren't commercial banks. But that gives you a sense. There's a lot, hundreds of millions of deposit accounts. The aggregate of the deposits at the commercial banks is reported weekly in the Fed's H.8 report. That is tabulated on Wednesday. It is reported on Thursday. So if you want to know, the total amount of money on deposit at commercial banks, go to the H.8 report and you can see it there. The Federal Reserve account holders, so the central banks and the U.S. government and commercial banks themselves, they all keep deposit accounts too at the Fed. But those accounts are being held at 12 different regional Federal Reserves banks. And the sum total of deposits by holders of accounts at the Fed is also reported weekly. It is reported in the H.4.1 report. Again, it is tabulated on Wednesday and it is reported on Thursday. So that tells you right there that it is indeed a split circuit. There's two separate reports to track the deposits at the two different tiers in our monetary system. And those two tiers, people think of the monetary system as being one tier, and that leads to a lot of confusion. There's two. Rest assured, we'll see this. But let's look at the split circuit monetary system maybe another way, graphically, to underscore one key point about it. So here we have split circuit monetary system, and on the left we have the public circuit, where I'm going to simplify the diagram. It's the Federal Reserve is issuing money to commercial banks, and it is circling back to the Federal Reserve. The Federal Reserve might buy an asset from a commercial bank, which turns around, sells it back to the Fed. That's a basic stripped down circuit. The retail circuit on the right, in red, commercial banks are issuing money. Again, I'm going to simplify this. They issue money to you and me. They issue it in the form of loans. We pay the money back, and the cycle begins anew. And that's really the system. I wanted to do this diagram, though, because you could see here in the center of the diagram, the commercial banks occupy a special position in the two-tiered split-circuit monetary system. They are both issuers and users of money. in the center here. So you could really draw a box around them. Now, you and I in the retail circuit, we keep our money on deposit at the commercial banks, which in turn keep their money on deposit at the Fed. So there you have two different systems of deposits. And there's a couple things worth noting here. One, deposits in the retail circuit, those are the deposits that would go into anything. They make retail purchases, including purchases in the stock market. Okay, so if you want to drive up the equity market, you need to control the retail circuit. The wholesale circuit's not going to do you any good, at least not directly, because nobody transacts in reserves. The second point worth noting is that the Fed, for a very, very long time, only indirectly controlled the amount of deposits. Obviously, the Fed can completely control the blue deposits in the wholesale circuit, but its control over deposits in the retail circuit and money in the retail circuit was limited, historically limited, because it was tinkering. What the Fed would do is tinker with interest rates on deposits in the wholesale circuit, and that tinkering with interest rates on deposits in the wholesale circuit would cause, in sympathy, an interest rate increase, say, in the retail circuit, and that would limit the number of deposits. It would tend to restrict the number of deposits because at a higher interest rate, fewer people are inclined to take out loans. So it was a very indirect system of control, and that has changed. That changed under the cover of pandemic. That has changed very much. But the Feds, the totalitarians, they don't like this system. They want direct control. They're going to get rid of the public-private distinction. They are going to change the two-tier system and then replace it with a central bank digital currency system in which the commercial banks are no longer going to issue money, and so that you can dismantle the channels of the monetary channels there. And eventually what you're going to end up with is a system where our deposits, they're going to be on deposit with the Fed, and you'll have one circuit here. The Fed will issue money to you and me, and that will complete that circuit, and we'll have one big happy totalitarian system, and that will be that. That is where we are headed.